Hey guys, this is Vu here. Today we're going to talk about real estate. As many of you guys know, I've invested in the Chicago real estate market for the past 6 years. For the most part, these properties do pretty well. And the reason they do well is because I approach it from a very analytical point of view. I look at some very simple but powerful metrics in order to evaluate these properties, and I evaluate tons of property constantly in order to find the hidden gems within the Chicago real estate market. So today you're gonna follow along with me in order to see some examples of how I evaluate properties. One of the things that I want to point out is that when you're starting off in real estate, you can do one of two ways. Either you find properties that have high monthly or yearly cash returns at the expense of lower valuation of the property as the year goes by, because these higher cash returns are generally in the seedier parts of town. Now, the other part is finding properties that are in much more developed parts of town, but their prices are already super high because there's much more demand for these types of properties. So because of that, your cash returns, your monthly and yearly cash returns are going to be much lower. But in the long run, these properties, they appreciate much more. And so these two paths are choices that new real estate investors usually have to figure out. So when you're low on cash, you want to go with the higher monthly and yearly cash route, but that involves more work. So today we're going to focus more on the former, because that's what when I first started, I didn't have that much cash. So I went about finding higher cash ROI properties. And so let's take a look right now. So if we go to cookcountytaxcompare.com, which is my website, in here, if you click real estate ROI, you're going to see a bunch of inputs on the left. That's a bunch of metrics that you're going to find that we're going to enter in to evaluate these properties. And so how I find properties, it's just on redfin.com. So when we go to Redfin, one area that I really like is the Austin neighborhood in Chicago. It's up and coming neighborhood. The mayor of Chicago lives around that neighborhood, and property rentals are pretty consistent there. And there's been a good amount of demand lately for properties around that area. But at the same time, it's not developed enough that the property prices are sky high. So it's still affordable. So let's type in Austin, Chicago. In here, we're gonna find a bunch of properties. Like I said earlier, we're gonna try to find some higher cash ROI return properties. And we're going to focus on 4-unit properties. The reason we want to focus on 4-unit properties is because that's the maximum number of units that can utilize an FHA loan. FHA loans are basically government-backed loans that allow you to put 3.5% down, only 3.5% down of your money in order to buy the property if you qualify for the loan. So this maximizes the amount of property you can get while minimizing the amount of cash that you need to put down payment on the property. And when you're a new real estate investor, this is pretty much the way to go. So these are all the properties within the Austin neighborhood. If we click on filter, we're gonna do 4+ baths, just to find 4 units, minimum 4-unit properties, and we are gonna do 5+ beds, multifamily. So it looks like there's 12 homes currently in the market, and looks like in here they're including more than just the Austin neighborhood. But let's go through and see some of these. So Oak Park is right next to it. This is South Austin. This is the Austin neighborhood. So let's click on this one. This is $950,000. It looks like this is 6 units, 6 1-bedroom, 1 2-bedroom, and 2 3-bedrooms. So it looks like a 9-bedroom unit, 9-unit property. Excuse me, 9-unit property. And if we go to property details, we click interior, you can kind of see that the estimate rentals from each unit. So it looks like there's 1 unit that's 1,100. There's 6 units that's 1,000. there's there's 2 units that are 1250, and that's basically it. So let's enter into our calculator. Let's put this to the side. So if we pull this, let's go back to the property. So let's minimize this a little bit. So the property asking price is $950,000. 950,000. Now the stock market returns, we're just gonna leave at 9%. Basically, we're gonna compare it to, since we're gonna have to put down payment and budget cash in order to buy this property, we're gonna compare it to what if we use that cash and put it in the stock market. That's S&P 500. Would it outperform it? Down payment is gonna be, this is a 9-unit property, so it would not qualify for FHA. It would not qualify for a regular conventional loan. So you would need a commercial loan that requires 20% down. So we enter 20% down here. So basically, we're gonna need $190,000 down, and then plus another $20,000 in closing costs for a total of $210,000. It's gonna be a 30-year loan. Interest rate, let's say 7%. Number of units, we set 9. So let's enter in all the cash and all the rental information that we saw earlier. So 1,100, 1 unit of that, and there's 6 units at 1,000. So 1,000, 2, 3, 4, 5, and 6. And then we have 2 units of 1,250. 50 and 1,250. All right, so our total is gonna be $9,600 in rent. Water, I generally put about $50 to $75 per unit. So let's put $450 per month. Water, electric, $100 just for the common area. Insurance, around $600 per month. Commercial property insurance rates have been skyrocketing, so it could be a little bit more than that. So we'll actually make it $700 per month. Taxes, if we go over here to tax history, it looks like they paid $6,000 in taxes in 2023. So let's do taxes. We're gonna do about $600 a month, or maybe like $580 a month in taxes. Management, pay someone to help manage. Vacancy. How I think about vacancy is that I would have for 12 months of rent for all the units, I would have 1 month of it as completely vacant. For a worst case scenario. So it's about, I'll put it as $533 per month. And then repairs, I'll put $500. There's no HOA. And so that's pretty much it. So let's take a look at this property. As I mentioned, $9,600 per month. Total mortgage payment without escrow is $5,000. Again, you're putting down $210,000. Your monthly cash flow, so which is pretty much how much profit you'll be earning, is $1,200. Your break-even rent is $8,400. So you're making $9,600, but your break-even rent is $8,400. So this property, with all these numbers, will cash flow positively. Your first year net operating income, which is basically profit without subtracting the mortgage, is $75,000. Excuse me. Cap rate is 7.9%. So cap rate is pretty much is your net operating income, your profit, not subtracting your mortgage payment, divided by the property price. So 7.8% is high for a very very developed area, but it's very common for these up and coming areas. Your cash and cash return is 6.75%, which is not that great, to be honest. And the reason it's not great is because you're putting $210,000 in, and we're going to compare that against the stock market in a bit. Your first year profit, this is a profitable investment. It'll be $22,000. Now, the big question is, should you invest in this property versus if you were going to invest in the stock market? So we can take a look at this chart right here, where the red is the returns from the stock market and the blue is the return from this property. So if we're going to evaluate for, let's say, a 10-year horizon, it is not. So $210,000 in 10 years at 9% interest rate will be about almost $500,000 if you put in the stock market and do nothing with it. Versus in here, in 10 years, you'll be profitable by $55,000. And why the difference? Even though it says first year profit is $22,000, the reason is because of that $220,000 you have to put in. So you start off by being negative $168,000 in your first year. So now let's go for another one. This is a $900,000 property, and let's take a look at the rentals. So interior, so 13 unit property at $1,200 each unit. So this is $900,000, and you'll also need 20% down. So at the end of the day, it'll be $180,000 plus 20,000. So it'll be $200,000 for 30 years. Interest rate 7%. So it looks like they're claiming $1,200 per unit. So let's do that. But it's a 13 unit property. So 1,200, 1,200, 1,200. All right. So it looks like total rental income is $15,600 per month. Water, $650 per month. Electric, say $100 still. Insurance will actually make it like $800 per month, since it's more units. Taxes. So let's go this property. If we go to tax history, there is no tax history. So we'll have to figure that out, but let's just say it should be around $600 per month. Management 500, vacancy 600, repairs. Yep. So let's take a look at these numbers. $15,600 per month. Monthly mortgage payment is only $4,800. Your break-even rent is $8,500. Your first year NOI is $142,000. Huh. So this unit is very profitable. Your cap rate is 15%. Cash on cash return is 42%. And so basically your profit divided by the worth of property, your yearly NOI, net operating income profit, is 16%, which is really good. 42% cash on cash return. So your $200,000 that you're putting in, you're getting 42% of that in your ROI your first year, which is amazing, actually. And your first year profit is $91,000. So if you look at this chart right here, comparing this versus the stock market, the first year it is underperforming. So let's actually zoom in a little bit. The first year is underperforming, but then after year 5, it outpaces the stock market. So after 30 years, it actually is worth $3 million in profit versus $2.6 million in the stock market. And this is not even adding in the fact that you'll be gaining equity on the property. In 30 years, this property will be paid, and let's say it'll be worth $1.5 million. So this metric, this blue line, actually way underestimates the value of the returns of this property. So for this property right here at 840 North Massanet, this is actually a really good buy. And if you look at it, this is a very popular home. You found this useful. Again, my website is cookcountytaxcompare.com, and in there you'll take a look at the property tax ROI and do your own analysis. Have a good night. Bye.